Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for being with us on one of the 42 radio stations, on YouTube or iTunes, or maybe you're listening on commercialrealestateshow.com. Well, today we're going to talk about the multifamily market. You know, the apartment industry has had a wild ride. There's a lot of new supply being built, and we've had great increases in rental rates and occupancy. How long will it last? I think a lot of people have questions, so let's get them answered. Please welcome my first guest. It's Jay Parsons. He's Director of Analytics with MPF Research. Jay, thanks for joining us.
My pleasure. Thank you, Michael.
Well, Jay, let us know, year to date, where are we? Has this strong performance we've had in the apartment market continued?
It absolutely has. You know, going into 2015, as you probably remember, most expectations were we would see some slowdown in the apartment market in 2015, and really the opposite has occurred. We've seen further acceleration in demand. All this new supply starting to come in. Demand continues to outpace supply, so vacancy rates have continued to trek downward, at least on a macro level. And even more impressive, rent growth is at the highest levels we've seen for this entire cycle.
Why, right. So what are some samples of vacancy and how they're trending?
Nationally, occupancy is now at 96.2, so vacancy of 3.8, which is the best it's been since briefly in 2006, but really unusually low levels of vacancy for the country overall. And we have seen that pretty much across the country, where overall vacancy went down about 40 basis points in the last year. That's
amazing, and that's pretty much considered full occupancy, isn't it?
Absolutely.
What about rental rates? What are you seeing there?
Like I mentioned, continued acceleration. We are up to 5.6% year-over-year growth in new leases. Again, that's the best that we've seen going back more than 10 years now, really since the tech boom. Very strong growth, primarily driven by the west region of the country, but also some unusually strong numbers really in most markets everywhere.
Interesting. So what are some markets that may surprise people?
Well, I don't know if there's any surprises at this point because everything's been so strong, right. But what's part of what's really driving up this story is one of the surprises has been, I think most folks thought that we'd see at this point some slowdown in the initial hot markets, places like Bay Area, Denver, Seattle, Texas, some of the areas that are getting a lot of supply, but we continue to see very strong rent growth in those markets. And on top of that, what's also helping drive up the numbers is that we're now seeing some really strong numbers in the late recovery markets. The markets got hit pretty hard in the downturn, just took a while to get going again. Places like Southern California, Phoenix, Vegas, Atlanta are all doing very, very well right now.
Yeah, that's interesting. And we're based here in Atlanta. We certainly see that. So these are great numbers, great news, I guess, for apartment owners. Is it across all classes, or is B doing better than A? And what do you see?
Yeah, that's a great question. You know, what's really been fascinating is overall A and B continue to do really well. C almost always lags, so you get a little more challenges in that market. But even there, we're seeing rent growth around 3%, which is actually still the highest in a decade for Class C. But really, the interesting story is the divergence between the urban submarkets and the suburban. In particular, if you look at the suburban A properties, the Class A suburban properties, they are really the top performers right now as one niche. The urban A market is starting to show some signs of pressure. As you're well aware, in this cycle, developers and the money behind the developers has been intensely focused on urban infill development, and we are starting to see vacancies tick up a little bit there just with so much supply, very, very luxury, high-priced units. And when you have very transient renters who are renting those spots, we're seeing a lot of competition and concessions where people are pretty easy to jump from one property to the next, because in a lot of these downtowns you can't go more than 2 blocks without finding a new apartment property under construction. So there's a lot of options these days.
So I guess it's time to build more in the suburban markets, right?
It really is. But what we're hearing from developers is that the conventional wisdom and which is really proved to be a myth, is that the suburbs have these low barriers to entry. But the opposite has been true. In fact, since 2007, we've seen on a relative basis faster supply acceleration, supply growth inside downtown submarkets compared to the suburbs. And part of that challenge is that in this last cycle, developers have been trying to be smarter about where they build in the suburbs. So we're trying to avoid the lessons of building out sprawl areas and, say like far west Phoenix. But the problem is they're trying to build kind of infill, strong suburbs that have strong employment hubs and transportation and amenities, things like that. A lot of them have strong NIMBYism factors and very restrictive zoning compared to the urban areas, and you really can't find a downtown in this country that's not trying to incentivize downtown redevelopment.
Yeah, that's a very good point, and we certainly see the same thing in some of the suburban markets. It's really hard to get a property entitled and get it zoned to build it. So what do you expect moving forward? What might happen next year with rental rate growth and occupancy?
That's a great question. It's obviously one everybody's focused on. Mm-hmm. And, I think that first of all, I think the most important question is what's going to happen in the broader economy, because I think a lot of folks try to overanalyze what could derail the apartment market. And historically, it's pretty simple. If the economy does well, the overall apartment market will do well. And most folks think that moderate economic growth continues. And so if that's the case, I think what you're going to see is that the Class B properties and the suburban Class A are going to continue to do very, very well. We do expect to see further slowdown in the urban submarkets, and so for the next 2 years or so, we're going to see just incredible volumes of supply. And so I think the overall apartment market numbers are going to come down a little bit, but that's going to be, again, primarily driven by the supply pressures inside these downtown areas. And
when you say come down a little bit, you mean the growth of those numbers, the acceleration going down, not really the occupancy going down, the rental rates going down, or do you mean that?
Oh, yes, absolutely. Occupancy, we do think will come down. Vacancy tick up a little bit. Mm-hmm. But again, that's primarily going to be, more supply than demand in some of these urban submarkets. And rent growth we see slowing down into the right around 4% for 2016 is our forecast, which is still, as you're aware, a very strong outlook.
Right. That's a good point. It's a slow down at 4% increase. That's pretty nice.
Yeah, you won't get many complaints with that.
That's right. So what do you see for cap rates and sales volume in the apartment market? It seems like it's pretty frothy. Everyone likes apartments these days.
Yeah, it continues to be a hot market. Cap rates, according to RCA, are now below 6%. 5.8% was their number for Q3. We've continued to see obviously very low cap rates, particularly in high-rise, mid-rise, kind of more urban product, and so we've seen more activity for garden, and that's driven down cap rates there as well. But very strong volumes, and obviously the numbers are about to go up even further with the two recent announcements of very large deals that Milestone and Starwood have been involved with.
Yeah, and with you expecting rental rate growth at 4% and kind of overall nationally next year, do you expect that this demand for apartments then will continue, and that and how might that affect cap rates?
Yeah, so obviously, underlying renter demand we think will continue to be very, very strong for a variety of reasons. In terms of investor demand, you are seeing a lot more concern among some of the institutional investors. In fact, looking at some of the RCA data, and you're starting to see some of them becoming net sellers. But outside of that kind of upper echelon of investors, I think that there's still a lot of foreign interest and other places where there's a lot of interest in apartments. I think what's really tripping people up is you look at the underlying fundamentals, and you really don't see any of the telltale signs of a frothy market or of a bubble. And so I think a lot of what, for some of the folks who are starting to get a little nervous, it really has to do primarily with the fact that they look at it and they say, hey, cap rates are lower than they have been. But, that spread between the 10-year Treasury and cap rates is still very large on a historical basis because Treasury rates are so low. And on top of that, all of the other traditional, kind of fundamentals that you look for, you really don't see a lot of concern. So it really just has to do with the underlying fact that the fundamentals are so strong. I think some people are a little bit nervous saying, this can't possibly continue.
Yeah, that's a good point. And we're short on the break here, but what would be a closing tip for our audience? What might surprise people about the industry today?
Well, that's a great question. I think there's a variety of things, but we, going back to that suburban story, we've done a lot of research with our team on the suburban versus urban, and I think the mistake our industry has made throughout this cycle is assuming that suburbs are always underperforming versus the urban areas. In fact, when you really just drill down to the kind of suburbs where you'd actually want stronger suburban areas with jobs, with higher incomes, higher home prices, these types of areas tend to be easier to get into, and from an investment standpoint, not a development standpoint, in terms of a higher entrance cap rate, lower price per unit. And then also you look at returns, and you tend to get better returns. And so I think there's a lot of myths related to the suburbs, and I think going into this next cycle, I think that investors would be wise to think about that a little more strongly.
Good tips, Dave. We'll have more on the multifamily market. The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit creshow.com.